We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 59. As always, joined by the three amigos. We got Rich Diaz of Acorn Macro Consulting and Keith Dicker, everyone's favorite boomer. New haircut today. Ready for the live event. Looking good. Welcome back to the show, gentlemen. What's new?
What's new is that Canada put up a valiant effort in its first World Cup appearance since 1986. Keith must have been just graduating from college. Who knows? But I watched the game. I was so proud of the boys. They dominated Belgium, who, by the way, is ranked second in the FIFA World Cup and the world rankings. Canada lost, sadly, because of just like one defensive breakdown. But I'm just so incredibly proud to be Canadian. We played so well. This is the Football World Cup, by the way, for people who live under a rock. And it's held in Qatar this year. It's disrupted all of the football seasons throughout all the world. But hey, as long as Sepp Blatter gets paid, that's the most important thing. But the Canadian men's team made Canada very, very proud. It was a tough loss. Alphonso Davies missed the penalty, which was... He probably should have made that. But yeah, man, it was amazing. It was a great game, although we did lose. But hey, we're not supposed to win at soccer. And we'll see. The next game, I think, is against Croatia, which is definitely a winnable match. And then I can't remember the third game. But yeah, stay tuned. I really think we can do something this year. So there you go. That's
we don't have no participation medals here, Keith.
I love what Rich, you're right. I think this has the potential to really build momentum. I think they have a real shot to get through to the next round. Do you remember the I don't know, remember it was the Olympics a few years ago, and the Canadian women's rugby, I think it was sevens that they play, right? 7-a-side, I think. I just remember watching that team, and they were unbelievable. And like every game, the momentum kept building for them. I mean, I think this is a great time. I know in Canada, we're always focused on hockey usually, but this is a pretty big deal, and hopefully we'll get through. But hey, watch the matches. They're fun. There's so much reaction. Of course, everyone saw Japan beating Germany as well.
It was an amazing game.
Yeah.
Full value for the win. Full value.
Yeah. Okay, here we go.
Rich,
what else? I did get my hair cut, right? So that looks good for people who can't see it.
Himself.
You look 10 years younger.
I know. I used a stew bowl this time, not a soup bowl. I had to get a bit bigger. But off we go. What do you got this week, Steve? What do you got there?
Just we'll open it up as always on the Canadian front here. Just a little bit on the couple notes on we had our good friends at the Bank of Canada. We're out this week. Carolyn Rogers actually gave a speech for, quote, the young persons of finance. I guess it's some sort of club or something. I don't know. But anyways, she went on to say that house prices were too high and that they needed to come down, which was kind of ironic, obviously, given the crowd that she was speaking to and their role in inflating said house prices. But, coming off of that was quite interesting because they actually released a report, and they released a report based on of what everything we've been talking about on the Loonie Hour here for many, many months. And it seems like the policymakers and the regulators are finally starting to sniff it out, which is these variable rate, these fixed payment trigger rates that are now sort of sweeping across the nation. So you actually had some data that was released last week from Desjardins. And so Desjardins says basically nearly every borrower who took out a fixed payment variable mortgage between May 2020 and July 2022 now owes more in interest than their monthly fixed payment. So pretty stark. Now, if you continue on that path, the Bank of Canada, like I said, just released a report. And per their report, they said that about 50% of all variable rate mortgages with fixed payments have already reached their trigger rate. So this represents about 13% of all mortgages outstanding in Canada. So just to give you a little bit of context, so basically 13% of all mortgages in Canada have reached their trigger rate, and that doesn't already include true, authentic, real variable rate mortgages, which actually float. So if you take the whole sort of basket of variable mortgages in Canada, about 1/3 of them have this floating rate. So where your payment will automatically change as soon as the Bank of Canada raises interest rates. As soon as the prime rate changes, your variable payment will change. The other 2/3 are these fixed payment mortgages. And that's basically when, again, less of your payment goes towards principal and more of it goes towards interest. And so basically what the Bank of Canada is saying, 50% of all of those have reached a point where they're not paying anything towards principal. It's all going towards interest. And so again, and in some cases we're seeing obviously where the banks are saying, hey, listen, you're not even paying any interest right now. You're not paying enough of your interest. You're paying zero principal and you're not paying enough interest. So we need to increase your payments so you can pay all of your interest, or we'll actually add it back to the sort of balance of the mortgage. So anyways, this is a real problem. The Bank of Canada has clearly started flagging it.
I have a question for you, Steve. Have you seen any analysis or thoughts on what happens if there's another quarter point increase in prime or 50 basis points? Like at what point does it become even more severe? Because I assume it's an exponential curve we're looking at.
Yeah, I don't have that. Nobody seems to put that out, but obviously, like the problem just compounds, right?
Because we had to be at the edge now, right? If all of a sudden we're at X percent, they've already reached the trigger point and whatnot.
I mean, if you're on a floating variable, which again, like I said, 1/3 of all variable mortgages are floating, those people have been getting crushed this year. It's the people that have had these fixed payments that can hide more or less, that they've kind of gotten away from it a little bit. You've seen some increases, but the problem is they haven't been paying any principal. So that becomes an issue at renewal 2, 3, 4 years from now when you've really had an interest only loan and you got to renew your mortgage. So this is actually from our good friend Ron Butler. I think he's a listener of the show. God bless him. Great follow on Twitter, the mortgage guy. So he's saying that he's now picking up that banks are actually getting calls from people who can't pay their mortgages. And so he's saying that basically if the mortgage was originally insured, which means, less than $1 million purchase, less than 20% down. So you have to go through a mortgage insurer such as CMHC, that on emergency request from the lender to the insurer, the borrower can actually be allowed to extend their amortization to 40 years. And there may be an opportunity to defer a payment. But that is not yet available for uninsured mortgages, which is basically any mortgage that has a purchase price north of $1 million. So the regulators basically, again, if you're going through the insurance program, which is backstopped by the federal government and us taxpayers, they are actually in some cases allowing people to actually extend and pretend, basically.
So now that I think it's a really good time to remind all of our Canadian listeners what the head of the central bank said on July 2020. He said, if you got a mortgage or if you're considering making a major purchase, you can be confident rates will be low for a long time. And I remind everybody about this because I like to hold a grudge. And that is what the central bank governor, the head of the Canadian Central Bank, said almost 2 years and 2 months ago, and then proceeded by raising interest rates at the fastest pace in 40 years. I'm going to say it. I know I shouldn't say it, but I'm going to say it. That guy should be fired. And it's an absolute, I think it's really embarrassing that he said that. And it's also really sad for the people who took that advice at face value, because he's one of the most important technocrats in our country. And went out and bought a variable rate and levered up and did all these things. That's why you have to be really, really careful when you're in that job. And that's why you get paid those big bucks and you get these beautiful pensions. But yeah, so I couldn't resist but of reminding everybody of that.
I mean, that's a great point. Just to add on to that, people always say, well, he didn't give a specific time. He just said for a long time. It's kind of no. If you read the monetary policy reports that they put out, they give you their forecast for interest rates. And so their forecast was actually for no rate increases until at least the end of 2023. That was in their monetary policy report.
Wow,
so,
I actually didn't know that.
Yeah. So they did give you basically like a specific timeline. Again, life happens. World's a complicated place, but a pretty bad call.
Well, as Bob Euchre would say, it's just a little outside.
Yeah, that was so anyways, that's kind of what's happening in the Canadian housing front. Like I said, I think that a lot of the issues, I think with these, I think people are really struggling. I'd be curious to see. I mean, I think we had, Rich, correct me if I'm wrong, I think we had like decent retail sales data last month, and I don't know if they broke it down. Like, I don't know if how much inflation is actually, boosting those numbers. But I have to think that with such a highly levered economy that is so predicated on like borrowing from your house to go and spend money, last week we talked about it, national house prices. Nationally, the home price index is down 15%. Or you could say your average home price has dropped by $132,000 since peaking earlier this year. So your house prices are falling. Your debt servicing, your interest rates drop 400 basis points. I have to think retail spending just gets clobbered in the months ahead. But again, the data hasn't really rolled over yet, and that's why I really am skeptical that this data is really telling us the whole picture yet.
So I think it's a really good point, and we've discussed this in a different context a couple of weeks ago. And so, just so people understand, retail sales is up 1.2% year on year in real terms. In nominal terms, so when you include the increase in prices that everyone's feeling, it's 6.9%. The problem with these retail sales data is that it's an aggregate total. So it doesn't account for the fact that Canada's had the highest population growth in 55 years. And I think that that's sort of where the rub lies, right? So I think I should actually have already done this. So forgive me, and maybe we'll have it for next week. I promise to actually, which is if you do it per capita, it's almost certainly down. And I will share that next week.
Speaking of per capita.
Oh yeah.
You had
more
some interesting news you want to share with us?
Yeah, so let me bring it up here. So the OECD, which is an acronym which I can never remember.
Don't worry about it. It's just some organization.
No, it's a very important organization that we should, have for respect for these people. There's a lot of smart people out there trying to just figure the world out like we are. And they came out with a real GDP per capita forecast. Now, anyone who knows me or follows me knows I'm not a big fan of forecasts, so take this with a grain of salt. But they do a forecast based on all kinds of things. So debt or inflation expectations, growth potential, output gaps, population growth is an important contributor. productivity growth. Anyway, so they rank the OECD countries. I think there's like 30 odd countries. Includes places like Turkey, Estonia, Japan, Australia, Chile, whatever. And the forecast was for per annum real GDP per capita growth between 2020 to 2030. Now, I think this was done a couple of quarters ago. I don't think this is exactly it's not super, super recent, but be that as it may, at the top of this list is Turkey. I'm a little dubious about that. Although they have a growing industrial base and they have other small countries like Estonia and Latvia. Poland's having a hell of a resurgence and they're at the top of the table. And at the bottom of the table, you'll be happy to know, Keith, Italy is there. And below Italy on this OECD forecast is dear old Canada. And with an expected real GDP per capita growth of less than 1% per year over the next 10 years. So we'll see. I mean, obviously everything can change. Like I said, I don't like forecasts. So, you've got to take this with a little pinch of salt there, but it is interesting that some of the top economists in the world are not exactly thrilled about what's going on here. And it's, you reap what you sow, I suppose, but there you go. Next week, I'll have the retail sales data.
Yeah. So, I mean, actually, I think one more thing. I'm in BC here. So we got our new sort of premier of the province, David Eby, who's actually I don't know if I'd call him a friend, but him and I have had a few conversations in the past. He's taken over on the housing front here because it's kind of interesting. The only reason why I bring this up, because I know we've got Ontario listeners that go, why is this guy talking about BC? Is that I find that the policymakers are now having a lot of the same conversations and you're seeing a lot of the same policy measures being implemented. And so the BC government has basically announced that they are going to be eliminating rental restrictions in all strata buildings in BC.
What does that mean? What's an all strata building?
So like you've got a condominium, right? Like a condo building, and you've got a strata that says, hey, listen, there's 100 units in the building, but, we're trying to keep it sort of like quieter, more local, so we only want to allow 20 units in the whole building to be rented because we want to have less tenants and we want to have more owner occupied people living here. So that's fairly common. Now he's bringing legislation. It's supposed to actually the day that we're recording to basically remove that. So he wants to say, no matter what, I don't care what your building is. We want you to open up the doors and allow everyone to rent out their place. So the implications of this, I bring this up because it's actually quite interesting that I think people aren't really talking about is, yes, okay, you might free up some more rental supply. Great. But the big thing here is in the city of Vancouver and in BC, we have a BC speculation tax, which says if your home is not like utilized, if you're not like living in utilizing it for at least 6 months of the year or renting it out, that you have to pay like an annual tax basically of like your property value. So it's like, if you're a non-BC resident, it might be, I think it's 2% annually. And then you got the empty homes tax in the city of Vancouver, which says, again, if you're not renting out your unit, it's a 3% annual tax of your property's value. Huge numbers. But what people can check off when they go to apply for an exemption is they can say, well, my building doesn't allow me to rent it out. We're currently maxed out. Now, by removing this restriction, you create a scenario where you're forcing them to rent these out. But a lot of people own, like a lot of wealthy people, for example, they own like these pied-à-terres in the city where they just want to come and go as they please. And they're like, well, great, I have an excuse not to rent it out. I only want to use it 1 month of the year. So I think it's actually going to force these people onto the market. So it's interesting more just from like a policy business perspective, because I think you're going to lose a lot of like secondary investment. It's kind of just basically the policies I think are discouraging, wealthy people from actually, owning secondary homes in Vancouver and in BC for that matter. And Ontario is going down the exact same path. I think they just brought in an empty homes tax in Toronto. So there you go.
Do those work? Those empty homes tax?
Do
they knock on the doors and say hi?
I mean, it's a self-declaration. It's a self-declaration, but they do have they do have like an auditing team, and they do audit actually quite a few homes, and you got to like produce like energy bills and stuff like that to show that you're living in it. Like it is fairly invasive. I would say it definitely has freed up some housing stock. But like if you look at like house prices and rents, I mean, they're still going up like double digits historically. So I don't know how much, but I would say it's definitely discouraged investment for sure. Like why
And Vancouver's notorious for having these giant mansions that are empty, isn't it? Is that still true?
Yeah, I think a lot of that
Or
is
that
like
overblown?
media.
Yeah.
There's definitely, I mean, don't get me wrong, there's definitely portions of like the West Side, wealthy areas, a lot of overseas, particularly from China, that tend to have vacant neighborhoods. Yes. But I think it's a little bit overhyped. But I think again, long story short, I don't want to bore everyone to death in this micro stuff, but it's interesting because, like I said, this is take the lead from BC. Toronto has basically been replicating everything that BC's been doing. And then, you've got as of 2023, Trudeau and the Liberal government has brought in that 2-year foreign buyer ban, right? So if you're a foreign national without any economic ties to Canada with a job or a Canadian PR, you're not allowed to purchase at all. So it's interesting that all these sort of policies are coming into play, and like I said, in a bear market. There you go.
What else?
Keith, what are you looking at?
Well, right now I'm just enjoying the Steve and Rich show for 20 minutes now. It's going back and forth. That's fun.
This guy doesn't care what is in his mansion there in
I'm just
in
hanging out.
Halifax.
It's kind of, we often have views on things, and someone's view is irrelevant. Really what it is. Instead you have to say, okay, this is what they're going to do.
Yeah.
But I have to say, I think I have a pretty strong disagreement with governments trying to decide whether you're allowed to buy property and not rent it out, or buy it and not live in it. I just think it's just not right. So, but that doesn't mean they're not going to do it. So again, I think it's like they're just treating the symptoms of a much bigger problem.
I would agree.
Yeah, that's going to be. But listening to what's been happening, I just love the conversation that you guys are having there with the real estate side, and because when we're going to be in Toronto next week, of course, and it will be a Twinkie Bet event, because the Bank of Canada will be coming out, and it's going to be a live event. Like, do you get it? Yeah.
It's a live event for the Loonie Hour. It's a live event for the BOC as well, right?
Yes.
Sorry, so remind us when the rate hike where it's meant to happen.
December 6th, isn't it?
Yeah, it's the Wednesday afterwards, so the 7th, I think it'll be. So
Okay.
that's
Do we
what
still owe us a Twinkie from last time?
Yeah. People are really upset about that still. Eric Jones has been emailing in every day.
Yeah.
Oh, I love Eric. He's so nice with the emails.
There's a background story on that, guys. We have a Loonie Hour website, free plug, looniehour.ca, I think it is. Anyways, we have like this submission form. We got a lot of nice comments from a lot of our listeners. We appreciate the kind emails that come in, but there's one email that we get every single day. And it's like from this guy, Eric Jones. And he sends like a long email that says, let me help you boost your SEO, and goes on and on and on. And anyways, he just will not leave us alone. It's like this auto spam thing. Eric Jones, we are not interested in your SEO services.
Well, I keep responding yes to him. So that's why he keeps coming back. Okay, let's get back on track here, guys. I think we are now at the most interesting pivot point. It is coming up, and next week we'll have a really great conversation about it. When I say the bank, Rich was asking, what does it mean when the Bank of Canada meeting is in play? It's a live meeting. Is that they're going to do something, but as we mentioned last time, people have no clue what they're going to do because they're all over the place, right? A bunch of like a drunken sailors or whatever. So that's going to be a fun event. I suspect we'll have 3 different responses coming up. Rich might try to slip in a 4th one as well. I'm going to be a bit cheeky with it, but yes.
Well, I was going to ask you, sorry, I know you got the $1 billion Bloomberg subscription there. What are the rate hike odds at the moment? Last I looked a couple of weeks ago, the market was pricing in 65 basis points of tightening or something over the next 4 months.
So right now we're at 375, so 3.75. And the market is pricing in another 50 basis points plus maybe another one after that.
But that's 50 over the next, like, what, 2 quarters or something?
Well, it could, well, no, not 2 quarters. It could be anywhere. We could be there by January or by next October. The market has no idea how to price the Bank of Canada anymore. And that's my point. So we're going to have an interesting, I already have my number lined up, but I can't let Rich know yet. But this morning, let's tie with all this. I mean, the world is all tied together here. And, we're now seeing, we're getting the banking story here in Canada about what's happening with mortgages. I suspect the banks are also extremely, and we were talking about from a household perspective, we're worried about it. And but I know the banks are extremely concerned about this. And the banks talk with the Bank of Canada every single day. That is happening. So we could, I think, we are potentially at that terminal rate mark very soon for the Bank of Canada. I think that could be the next big surprise. So you look at what's happening there. And so the retail numbers you mentioned earlier, but they weren't good, guys. Like they were
they
negative.
weren't good. Sorry, I forgot to make that clear.
They were. It's not good. So the growth story is starting to roll over. And I suspect in Q1 for sure we're going to start seeing some struggles taking place. But today I want to sort of we have that happening in Canada. The Bank of England, they were chatting this morning at a conference or presentation, whatever they were doing over there, and they had some real interesting comments that they made. Probably the best one that they made. I even wrote this down. I rarely take notes for the show, but I did for this one because it looks okay. But their quote was that, a weakening economy is necessary to bring down inflation. So they've already stated that this is going to be one of the worst recessions, I think, over 40 years. I think that's what they mentioned of just a few days ago. But they are doubling down on this. They're telling everyone in Britain that, hey, it's going to get really tough out there. At the same time, they also alluded to the fact that they're going to ensure long-term rates don't go up, which is very similar. Now, they didn't describe exactly what they're going to do with that yet, but it's very similar to what the Japanese are doing right now. So the Japanese, they have unlimited quantitative easing, which means they're going to print as much money or yen as possible to make sure that the price of their bonds never go down. So the UK hinted, well, they didn't hint, they explicitly said they're going to go kind of that route. They've also said they're going to raise rates aggressively on the short end to create that recession that they're talking about. And then they also said, I didn't write down that quote, but they're very concerned about the currency side as well. So if pound sterling, if that depreciates, that's inflationary. So now we have the Brits and the Japanese are trying to do everything possible to prevent the bond market from going under, the currency market from going under. They want a recession to hit, which would hit earnings. So people believe in earnings drive stock prices. That should bring down equity markets as well. So they got a big thing happening over there. So now we have the Japanese, we have the Brits, the Europeans. In which they're a bit different. I know they sound alike sometimes, but they are different parts of the world. And we have the Bank of Canada here. So I suspect the Bank of Canada is going to be joining that main theme very soon. So if you want to have a thought on that, and then we'll jump over to what the Americans are facing this week.
Well, you missed one.
The Chinese
Bank of Korea.
I haven't followed it. Yeah.
No, I mean, they're not that important, obviously, but they raised 25 basis points last night and basically indicated that they're pretty much done. But the reason why I bring that up is they actually have extremely similar, Rich, you might be able to comment on this. They have extremely similar profiles on their household debt to GDP ratios are very, very much in line with where the Canada is. So they're large debt offenders, similar to sort of Australia, Canada, New Zealand. New Zealand's still pushing away hard on their rate hikes, but anyways, yeah, Keith, I mean, I think we can kind of see the writings on the wall that things are slowing pretty hard here, and central banks are slowly starting to sort of come around to the view that the damage is obviously being inflicted.
Yeah, I mean, and that's tying in with, because we've had a pretty good rally here lately with equity markets, over the last couple of weeks, and I just find it incredibly interesting because with the Americans especially, the economic data, it's what I would call dovish. It is showing that the economy is slowing, and which also suggests that the Federal Reserve should start to turn dovish. They should say, hey, we're not going to hike rates as aggressively as they were before, and that they call it the terminal rate when they stop. Maybe it should be lower than what they're suggesting. So so the market is it's playing a real dangerous game here, because every time the market's done this since August, Powell has come out every single time afterwards, and what do they do? What do the Mr. Burns do on The Simpsons? I'm going to crush them, crush them like an ant or something. That's
he tries to crush the paper cup, I think, and he can't because he's Mr. Burns. But anyway, it's a great
it's something like that. Yeah, I agree. And then you got the old man like yelling at the clouds.
That's you.
That's me, of course. But don't be surprised if the Fed comes out now next week. Not say the Fed, I mean Powell, by the way, with more aggressive language here.
Oh,
Good bit of a pause because Willis had to say hello to the mailman. And so the other thing with this, though, sort of tying in this whole recession thing, and it's funny thing. I think Rich, you commented on this, and Steve noticed it as well. I think a couple of days ago. I think the most interesting market movement that's happening right now is in the oil market, and in my opinion, in my view, oil is no longer trading based on a supply story. It's now shifted very abruptly to this demand story, and that demand story is in line with the recession, right? That's what we're looking at here. So oil's been a bit of the back foot here over the last week, maybe coming off, and at the same time, which other market is starting to rally based on it should with a recession coming?
Bond market.
Yeah, that's good, Rich. Which one?
Well, the Treasury bond market,
yeah.
380, down from 430, 427, or some intraday.
It's been a pretty good, it's been a pretty good move. So, so the way it works in the investment world, when you have a recession coming, you don't want to hold corporate bonds, because a corporate bond is backed by the profitability of the company. If you have a recession, in theory, they have less profits coming in, which means they may have a less opportunity to pay back the bond. So if you're going to stay in the bond market, you want to go to the government side, because, and again, in theory, they have an unlimited potential, to tax everyone, to death, basically. Did you know that was coming?
Well, I knew something like that was coming.
Now you're like Mrs. Icecap the second, right? We've been together too long.
That's a very high compliment. Thank you, Keith.
Okay. But now, but the long end of the bond market is starting to do better now. And again, the point is we're starting to see market movements that are in line with the way price discovery should be working. And the next one that will likely happen, I know, Rich, you keep great data with this as well, is on the earnings front. I'm not a big earnings guy. In my mind, markets move based on capital coming in and coming out of a market, and thereafter you can say, okay, that happened with earnings and stuff. But it's highly likely you're going to start to see even more warnings coming up from different parts of the economy, and then the 10 gig sectors that we will call it. But this now seems like we're now at the beginning of the recession that's coming.
Well, let me just provide some narrative. Like, the reason I look at the earnings is because there aren't any. And does that make sense? Like, if there were earnings, I think I'd be a lot less skeptical about the rally, right? We've gone, some markets are up 20% off the lows. I mean, the US is about to hit 4,000, or if we haven't already hit 4,000 on the S&P. And that's just this function of this hopium that we talk about all the time, right? With the Fed wanting to pivot. By the way, if you look at the implied interest rate, we always talk about the Canadian implied or interest rate expectations, sort of not really knowing what the Bank of Canada is going to do. I think, if I'm not mistaken, it's actually also split for the Fed for the first time in a long time, right, Keith? If you can just cross-check that, because I think whether it's going to be 50 or 75, and I think there was just a headline today saying it was going to be 75, and as you expect, Powell is going to be quite hawkish, even though the data is deteriorating, as you say. But the earnings things that I look at are I don't necessarily like models, but I mean, all of the models I do track are that earnings are continuing to deteriorate. Sales growth is deteriorating. And if you don't have sales growth or earnings growth, what ends up happening is you have, the combination of those is obviously, not obviously, but is margins, and margins also are deteriorating. And so a couple of weeks ago, we talked about the bond market rallying and the equity market rallying and which one was right and which one was wrong. I think we're going to find out really soon. Probably maybe sooner than some people hope. And again, I think we actually agreed that it was probably the bond market that was right. So it'll be interesting to see over the next 3 or 4 weeks. I think we'll get our answer.
Hey, speaking of the bond market, for the Canadians playing along at home that are sweating about these interest rates. Your Canada 5-year bonds down about 65 basis points over the past month. So it's a huge move there. We were seeing some banks reduce their fixed rates, but I think the other point too, I think we've talked about this too, is just because you've got this massive yield curve inversion. The 2s, 10s in Canada is inverted by nearly 100 basis points. It's funny, you can actually see this just in their mortgage spreads, right? So you're paying more today to lock in a 1-year fixed mortgage than you are a 5-year fixed mortgage. So it's totally backwards to what you're used to. But I mean, how much, Keith, Rich, how much do you guys put into that, that yield curve inversion? How much weighting do you put on that in terms of what the bond market's trying to tell you?
Go ahead, Keith.
I think it has a pretty good record. It's
me too. That's
what do they say?
9 out of the last 7 recessions.
Yeah, absolutely. Yeah, it's predicted 12 out of the last 9, something like that.
That's it.
But again, it's a function of capital will try to flow to where it can either not lose money, and that's what the bond market is about, or where it can make money. And I think a lot of people know that with institutional money, which is what rules the world, it's not what you and I are doing. They have some money has to be the bond market all the time, and they can make small allocations. They can shift from corporate to sovereign debt and so forth. So if with this inversion taking place, it means money is going into the long end of the curve, which is in sovereign debt, government debt, government of Canada debt. So I've been suggesting for a while we are headed for, initially back in the spring, I think I was suggesting it's going to be a slowdown coming. And now here we are. I think we'll be very happy if it's only a slowdown, because if we just get a slowdown at this mythical soft landing that the Bank of Canada and other central banks suggest that they're going to be able to orchestrate, we can work through that. And by we, I mean the economy and everything like that. I think the likelihood of that happening is quite small. I think we're going to hit a pretty big thud, and the danger we have with that here in Canada is that we've never witnessed this national housing bust before. Because if we do get a hard landing in the economy, it's absolutely just going to smoke housing, which means the banks take it on the chin, and it will have a knock-on effect, everywhere else. And because we haven't experienced that before, we have this sort of sense of invincibility that, we're immune from that. That's just something that happens to the Yanks, right? That doesn't happen
or in Spain or in Ireland.
Yeah, not Iceland. No, Iceland as well.
Oh, Iceland too. Sorry, excuse me.
Yeah. But that's my point there, right? Because, we have this, we all think in a linear fashion. And I just see risk all the time. That's just the way I live my life all the time. It could be really cool sometimes and just weird at other times. But right now, with the Canadian investment landscape, people haven't seen this before, and it doesn't mean it's going to happen or it won't happen. It means the probability has changed quite a bit, and it's going to slam some things pretty hard coming up. And again, we keep seeing these pieces of the puzzle. They're all starting to come together here now. And as we get more, economic data for December and as well as the January, I think then it's going to be a bit of a done deal. And there she was. China. I know we got to talk about China, right?
No. Before we do that, I want to take just one half a step back and talk about the yield curve just for a tiny bit. I think it's because people may not know the yield curve means the bond market, and the bonds can be issued at short term. So 1 year, 2 year, 10 year, 30 year. I think Austria issued a 50-year bond or whatever. And the reason that people say, well, yield curve inversion, why does that predict a recession 9 out of the last 7 times or whatever the joke is? And different parts of the yield curve, different maturities signal or incorporate different risks. So there's things called the term premium. So how far out the yield curve, how long your maturity, for example, do I think I'm going to get paid tomorrow? Yes, I'm quite sure, versus the day after tomorrow, I'm less sure. Therefore, as a lender, which is what you are when you buy a bond, you have to be compensated for that extra time. And so what the market is telling you now, different parts of the yield curve, in effect, provide messaging on different market and economic inputs or impulses. And so the further out the curve is about, let's say, this is broad strokes here, so forgive me, but is more about growth and sort of solvency. And then the front end of the yield curve is more about sort of economic policy. And so what you have, and more or less, I mean, this is a very broad subject that many PhDs in finance argue about and have done for a long time. And so what you're showing is as you're seeing the long end of the curve, whether it's the 10 or 20s come in, which means that the yields are falling, it's that the market is telling you it's worried about growth. However, the front end of the curve or the short end of the curve, there's not much movement at all, because the policymakers are telling you they're going to raise interest rates. And so there's people who say, oh, this is like a pricing of a policy mistake, or, this is what happens when you have a recession. Because what that does is that inversion tells you that there's really tight monetary policy, perhaps that's too tight for the situation they're in, and the market's worried about growth. And so you have that dislocation where the 10-year for the long end is lower than the front end, or let's say the 2-year. And if you look at over time, it tends to predict recessions in the US. It's not necessarily true of other countries, with a lag of 6 to 12 months or whatever it is that people will argue about. Anyway, sorry. Back to China. Sorry, some context there.
No, it was good. I think, brilliant. What was someone called the thing? Fun things with the rich. it's a new segment coming.
Because not everybody, I know my mom listens to this podcast and she has no idea what a freaking yield curve is. So that was for her.
No, it's funny. I actually think I just tweeted or retweeted Rob McClister there, who was posting with the 100 basis point inversion. Like, you go and look at the replies, and everyone's like, what does this mean? Like, explain it to me, like, in simple terms, right? And so, I mean, it's really as simple as it gets, right? The market is worried about growth, and central bankers are hell bent on raising rates in the near term. So, basically that's kind of a good summary. But yeah, I mean, part of this all as well is how these markets are all moving together. We've talked about China and oil and GDP growth. And, one of the stories, I guess, over the past several weeks has been, China is going to reopen, and oil demand is obviously going to pick up, and that could even create even more inflation, because you got the second largest, global market sort of reopening, all this excess demand that's going to come through that. And now we're getting reports that I think it was Beijing just shut down. COVID Shanghai, like COVID cases there are actually hitting all-time record highs at the moment. And again, we know that we've kind of moved on from COVID here in sort of North America, but over there, it still seems to be alive and well. So obviously, that's being reflected, Rich, in oil pricing. Perhaps some.
Well, Keith was going to say something before I interrupted him with the
Yeah,
yield
Keith,
curve.
go
Sorry,
ahead.
Keith. Sorry, Keith.
Yeah, it's not a very deep thought at all, but and it's not a very intellectual choice of words either. But China, what's happening in China? It's just weird. I like to be able to reconcile policy decisions with economic and market information and data, and what they're using COVID as an excuse to completely shut down their economy or to prevent people from getting out and doing stuff. So you probably saw the Foxconn videos from the last 48 hours. So those who are not aware, Foxconn is basically the
Chip maker.
No,
they make
they're the
iPhones,
big
don't they?
iPhone manufacturer.
But they make chips for iPhones.
Yeah, they
I
make
don't
all
know.
kinds of stuff. They make all.
Okay, whatever.
Mostly.
Yeah, they're putting them all together anyway. But the point is, the people they've been locked into the factory now for a long time, and they're getting restless. And there's actually riots taking place. They're trying to escape, and you can see these it's like armies basically of police coming in, all dressed in the white suits and everything.
The hazmat suit.
Yeah, it's and again, it's all very odd and strange, because for China to work, they need growth, and everyone is aware. Yeah, they grew because of debt and from global trade. That was the biggest driver of their growth, and it was no miracle. It's just debt. That's the way it works, and everyone is also aware that they need to shift to more of a domestic spending consumption, or that's what they need to do economically. But to do that, the households in China, they're already stuffed with debt already, and they're ticked off because of the housing market they're in isn't doing that well. So there's a lot of stuff happening at the time when it should be doing the opposite. They should be opening up. So my thought on it, and this is one of those, like it's Keith's thought. It doesn't mean it's out there, but I suspect things are a lot worse in China than what the data is showing, what the numbers are letting on. And they're just trying to make sure people cannot go out to protest. They cannot go out to sit in front of the bank, and things like that. But again, it's highly unusual what's happening over there. And at some point, something will break. Either, as you said, Steve, like they're going to, COVID is now over, that everyone turned the taps back on. Or it could be the opposite. You're going to get like a sharp escalation in social conflict over there. So that's where that is. That catches my attention as well, right? And again, it's big.
Do they actually? I haven't followed too close. Did they actually lock the employees into the factory? They got locked in. That's
so they've
insanity.
I gotta it's on the cover of the FT, by the way. So FT is Financial Times. It's the pink newspaper. It's what all the finance bros in London read. And on the cover of the freaking FT, you see all the cities. So I'm going to butcher the names, but Beijing, which is in the north, Shanghai, which is on the coast on the right-hand side when you're looking at the map. And then there's one called Shenzhen or whatever. And these cities, by the way, so it's not the whole cities, but I think it's like a couple of people contracted COVID in a hotel, and then they locked down the entire hotel and don't leave. And then the same thing at Foxconn's. Foxconn, by the way, is an enormous company that must employ, I don't know, I had to guess 100,000 employees. And they have these huge, it's a huge compound, right? It's basically a mini city that you drive into. There's a gate with a guy in a uniform or whatever. And in one of these enormous industrial complexes, I think one person tested for COVID, and they locked in absolutely everybody. Must be, let's say, just conservatively 3,000 or 4,000 people working on an assembly line. And they locked everybody in there, and they were not happy at all. And they started to really push back. And you're seeing this, that they've upset testing facilities in different towns. There's something fishy. I just got to add one little tidbit, which is amazing. So everybody must know by now that there's something called the World Cup going on. And obviously this is probably the most watched television or any kind of event, basically, And in China, they love soccer in China. And so when you watch the live matches in China, they've blurred out the stands. So just so we're clear, you watch, Messi pass it to whoever, you see the football players dancing around the pitch, and all the stands are blurred out. So you can't see the fact that there's 80,000 Qataris yelling and screaming at the top of their lungs, not wearing a mask, which is just an absolute wild little tidbit that I had to share. There's something weird going on there.
Between that and like the containment camps that they're building, something's fishy over there. But what's interesting here is like in Vancouver, I can tell you, that Chinese money has been a windfall for the city. I mean, I think you can throw the GTA into that as well. And man, the Chinese money just is not what it used to be. Like we had that like wild ride in 2015, 16 into 17. And really ever since then, and like, and I think COVID has just kind of exacerbated it, but I just feel like that money is like, I wouldn't say it's gone. Like there's a lot of that money that's still parked here, but like the new money coming in, it's just not coming in. You can see like all these like luxury products or projects that are, being developed for basically these buyers is just not performing at all. And so it's kind of interesting because you're like, well, who's the buyer of these luxury condos like moving forward? Like so many developers have made plans to sell these projects. And what's interesting is in 2016, 17, there was all these huge land buys. So we actually had a lot of like Chinese developers that came in to Vancouver and just started land banking. They paid any price for the land, you name it. So you have all the big local builders, all the top dogs that have been here developing for 100 years, smartest people in the room, offloading all their projects at top dollar to these Chinese developers. And you're like, well, how does these guys make the numbers work at these prices? And I think we're now starting to see the tide go out, and you're like, yeah, I guess it looks like it was all this kind of mirage. So we're hearing more stories of these Chinese developers that were land banking. Basically every year they just refinance. They go to a different lender, refinance, because every year the land value would just keep going up. So you just keep refinancing. It's kind of like a Ponzi scheme, right? As long as the market goes up, 7, 10, 12% a year, you refinance and the bad debt doesn't really show up. But now what you're seeing is, right, not only the land value is coming down, but the lenders don't really want to renew them because the loan to value is kind of eroding, and they can't get money out of China. They can't get money out of China. So I don't know. There's something going on over there that's more than COVID. But like I said, anecdotally here on the streets in our property market, we're seeing it.
Have you started seeing discounts on how does it work in the real estate game? Do you when you walk, like right now, if you go into say it's Black Friday tomorrow, you walk into IKEA, or whatever, there's like a sticker that says, minus 40%. How does it work with these condos and these developments? I mean, will they just slap on a sticker that says, 10% discount, we'll give you a Tesla and a popcorn maker, and if you buy this condo or whatever, or is it more subtle than that?
It's pretty subtle. Like you can't really like openly advertise, because what happens is you think about it, you sold 75% of the building, and then you start announcing to everyone on the top of your lungs that, hey, we're cutting the prices by 10%. Everyone that already bought in, the 75% of the buyers, and like, whoa, what the hell, man? And like that will then actually, if they still need to close because it's a new project, if they still need to close and get a mortgage, the bank can be like, well, hey, you sold it to this guy for, $700,000, but you're now advertising the new price is $650,000. We're going to give loans to all of these buyers based on the price of $650,000. So now you run into these risks of people that can't get financing to close in your project. And then you're dealing with a bigger problem on your hands. So the discounts tend to be, hey, we'll give you a credit, to decorate your home upon closing. We'll give you a lower deposit structure. So the last thing the developer wants to do is to cut the price, because of pretty much what I just said. So yeah, like I said, I think this is all sort of coming to a front where we're starting to see these interest rate buildups, the lack of liquidity. developers that are some of them stuck with products, some of them that won't get off the ground. It is going to get interesting. And like I said, I always look at this from a front lines perspective to sort of gauge, I know the Bank of Canada is looking at headline CPI on a year-over-year basis, but I don't know. To me, it looks.
Can I ask you another question?
Looks very deflationary in the months ahead.
Sorry, one more question on this. So I'm curious now. Like, so do you think the damage is done? So let's say, for argument's sake, there has been the pivot today, or not today, on December 6th, they raised by 50. In 6 months from now, they're saying, just kidding. We're sorry. We didn't mean to piss Keith off. We're going to start cutting. And by the end of 2023, they cut by 25 basis points. Do you think the damage is done? Like, just like looking ahead, I know this is like ridiculous speculation, but it's Thanksgiving and why not? But so just like, what would do you think the housing market would just immediately curve, or do you think that there's scar tissue, just like there was scar tissue in Ireland and in Spain and in the US?
I think it comes down to how long the rates hold here, right? So like if you get mortgage rates,
guys, I have to run. So you guys enjoy the rest of the chat, and ciao.
This guy's got a big hedge fund to run, so me and Rich will wrap it up. Keith, we'll see you in Toronto, buddy.
Cool. Bye.
Just to get back on that point is, I think now I've lost my train of thought.
No, my point is, do you think that, so my question was,
the scar. Yeah. Okay.
Yeah. Do you think so? For just the reason I bring that up is because, once the bubble blew up in Spain, it didn't matter what interest rates did, prices went down.
I don't think
Ireland,
it
was the same.
Yeah.
In the US, it was the same. And do you think that like in a year from now, if they start cutting, let's say January 2024, they cut interest rates by 25 basis points. Do you think we've had enough pain? Like, I'm just curious. I'm not going to hold you to it. Like the
I think
section will, but
the damage is, in my opinion, is not done yet. In terms of like even psychologically, because like we're seeing it all the time now, where it's like sellers that like are trying to sell, not really getting their price, small price reduction. And then they're saying, you know what, pull it off the market. Let's try again in the spring because it'll be a better market in spring. Like that's kind of the sentiment right now, that they're going to have more success in the spring. And so I think it really comes down to like, how long do rates stay at these levels, right? I think if mortgage rates come back down into the threes, relatively, like you said, in the next 4 or 5 months, I think we kind of get out of this relatively unscathed. We've already had decent corrections in some markets, but I think if rates stay like, even in the mid fours, it's too high. It's too high. And I think like,
for the debt levels, you mean, and the payment. So
so
your debt levels and the debt servicing, it's too high.
Yeah, and people forget that, like, so I know, like in BC, and I think the GTA is, I believe, fairly similar, but I'll go with BC for now, for sure. Let's just say this: let's say you are delinquent on your payment, on your mortgage payment, it takes like minimum 12 months to get that property into like a court-ordered sale situation. So it's like anyone that's like missing payments right now because your variable is up like $2,000 per month. Like if you're missing payments today, like you're not going into a forced sale, court-ordered sale for another year, at least minimum. It's a long, lengthy process to go through the court approvals, and you got to follow all the guidelines. So it's not like the US where it's like you miss a payment, like 30 days later, the sheriff's knocking on your door and pulling you out of the house. Like that's not how it goes in Canada. So that's why I say, like, I think the damage is done. Like you're not necessarily seeing it yet.
No, but the damage is not done. Sorry, the damage is not done.
The damage is not done yet, but I think like there's a lot of pain. I think that is out there that is going to bubble to the surface if rates stay sort of prolonged and we're in this like really crappy economy. That would be more of my concern. But right now, I mean, right, like we've been correcting for less than a year. It's been, we peaked in February and we're in just basically December now. Like it's only been like what, 10 months of a correcting housing market. That's not even enough to really see like delinquencies and stuff like that. So that will come to sort of fruition, I think late, like it's more of a Q3 3-story next year. And same thing for people that bought these pre-sales that now might not be able to get mortgages because they got to get, stress tested at 7.5%. Those people haven't really come up yet. So anyways, long story short, I think that the Bank of Canada, I still think is looking in the rearview mirror, but that's partially, I'm curious your thoughts. That's partially political, right? Like it's pretty hard to cut rates with headline CPI, which is what every consumer basically looks at when they pick up the newspaper. When headline CPI is still at 7%, pretty hard to cut rates. But we started out the podcast. I know we're wrapping up. We started out the podcast with me throwing Tiff Macklin under a bus where he belongs. But I will concede that being a central banker is a super hard job. That's why you don't make those claims. But anyways, the reason I bring that up is because in effect, you're sort of always driving, looking at the rearview mirror. And in some ways, I think it's your job to sort of anticipate. But I think if you anticipate things, you get yourself into trouble. And often, it's, what is it the doctors have to do? Like a Hippocratic oath, like first do no harm. I think I think that central bankers should probably take some kind of oath like that. But I also think that they're dealing with the best data they have at the time. And it's tricky. I think it's just I think they obviously made mistakes by keeping interest rates negative, in real terms for as long as they did. That was, I think, sort of an unforgivable mistake. And I think in some ways they're trying to correct it now. And I think that, correcting your mistake, e.g. scrambling for credibility after you've made what I think is a profound own goal, I think is a dangerous game. Do you know what I mean? I think that that's where we're watching central bankers sort of the world over struggle to recapture the credibility, the perceived independence that they are meant to have and portray and to project. And I think that you get yourself into trouble when you do those kinds of things. So I had a quick question for you and we'll wrap it up. You mentioned to me, you're like, when do you think, you're talking about like Bank of Canada does a U-turn and starts cutting rates in 2024. I've actually got a question for you, which is like, if you had to punt it today, like the data can change, things can change. People don't understand these are highly complicated, complex markets. Not going to hold you to it, but if you had to guess today, right now, when does the Bank of Canada get their first rate cut? When do they do their first rate cut?
I mean, what do I want them to do, or what do I think they're going to do?
What do you think they're going to do?
I think it'll be the end of 2023, early 2024.
Okay. So I'm going to go Q2 2023.
So now what can I say what I want them to do? I want them to keep the rates at 4% for 2 or 3 years and let the market clear. But I'm borderline in Austrian economics. We can discuss what that means in the next podcast. And I think market clearing is healthy part of a capitalist and liberal democracy. And
I think a lot of people
had any of that. So
yeah,
we
and
can
I think
discuss
a lot of
that
people
next
are rooting
week
for
over
that.
beers at the Loonie Hour live podcast.
Much to be discussed. As always, guys, we appreciate your support. We will see you guys in Toronto next week for the live event. Again, that live event will ultimately be recorded. We'll have it out on a regular time. So if you're missing it, obviously, that sucks, but don't worry. You'll still have the recorded version as usual. And I'll be asked that you leave us a 5-star review. We're actually a little bit short on reviews on Apple Podcasts. So if you guys want to jump over to Apple Podcasts, pump up a couple 5-star reviews, that will always help. We appreciate your support, and we'll see you next week.